All right, welcome back, everybody. It's Bryan Strains here, and I'm excited to talk about the topic that I'm covering today. And it came about because of another question. So you guys are still directing traffic as far as the topics go in this class. But I get to talk about one of those pivotal moments in my career as an investor, and something I really learned a lot about in one trade. So I want to talk about the question first that sparked this. And Joan was asking, do you feel it's necessary to consider whether a stock is overbought or oversold, or whether big money is buying into the stock or ETF? These are things I pay attention to with my trading, but I don't know if it's necessary with using risk, reward, and probability factors that Odds Online and you are teaching. I think that is a great question, a fantastic question. She says, I had done some looking at the stocks from your cheap options list today, and Snap is the one I noted did not have good money flow and is overbought. So it causes me to pause and wonder about whether I should even consider Snap as a potential trade at this time. So Joan, I think that you are right on target with what so many people are thinking when they're new to options trading. And I hope that what I have to say is going to help you a ton. I hope that what I have to say is going to help you so much. But I've got to point out that the number one flaw and the biggest challenge I think that new options traders have, we're going to talk about that right now. And it's this. The number one challenge for new option traders is they still think like stock traders. They still think like stock traders. And everything that you've learned about stock is not invalid. It's not worthless. It's going to be helpful. It's going to be helpful. But for options trading, you must learn to think differently. And you just gave me a forum that I can and phrase the question just right, so that I can help a whole bunch of people. Whoever watches this video, I want you to be able to frame that question and ask yourself, what do you need to think differently for your options trade? How do you need to think differently for your options trade? Okay, so the rules that are applicable to stock trading may or may not apply to your option trading. For example, and the trade that you mentioned was Snap. So for example, what does overbought or oversold mean to a straddle trader? So I can see how overbought and oversold might help if you're trying to do a directional trade, and because overbought and oversold are technical terms that come from technical analysis, and stock traders have been using them for a long time, and they try to hit reversal points. They want to, if something's oversold, they might want to buy it to be contrarian, and if something's overbought, they might want to sell it to be contrarian, to try and profit. And so people use those terms differently. But to a straddle traders don't care about direction. So they don't care about reversals at all. And the question I have, and the example that I have, I'm going way back here, okay? This is a trade that I took back in November of '99. I did this trade on a company called Protein Design Labs. PDLI is the symbol, and you can go back and look at it in Odds Online. You can see the current price up there is $3.63. So it's a completely different company now. Now they're just PDL Biopharma Inc. But back then, this is in the dot-com days, and things were kind of crazy. And so if you just look at this chart right here, the reason that we got into this chart, if you look at this chart, it's going up and then it kind of just sits flat up near the highs. So my question to you would be, is it overbought or oversold? Or how would you look at this chart using technical analysis or whatever? It didn't mean anything to me. I wouldn't have called it overbought or oversold or anything. The information that I wanted was this right here. You can see this blue line is the 100-day historical volatility. The red line is the 10-day historical volatility. And I was using the hedge fund straddle scan at the time. We didn't have it in as a sophisticated tool that we have now with odds online back then. But if you notice right here, the red line is less than half of the 100-day historical volatility line. And you can see with your naked eye how flat that stock got right there. It was just pancake flat. And that's what we were looking for. The stock is consolidated. It's looking for a breakout move. That's what we want with the straddle. We want the stock to make a big move in the near future. And this met our criteria. So the trade that I did was this right here. And this is close to my price in approximate days. I don't remember the exact date, or I know my price was in the 700s to get into this trade. And on this day right there, November 23rd of 99, at the close of that day, the price of the straddle, the 40 straddle, was $812.50. So this is approximately when I got in, because I know I was about $700 and change in this trade. And so that was in this time period right here. And you can see the stock just started moving up, and I got into profitable territory. It was making me really happy. And then I would ask, after this big gap up here, is the stock oversold or overbought? And up here, is it overbought? Up here, is it overbought? Up here, is it overbought? Stocks can go up infinitely. And when we do a straddle trade, or if you just buy a call option, your profit potential to the upside is absolutely unlimited. Stocks can go up forever. And it felt like that's exactly what this stock was doing. And I also want to point out something else here. Look at the implied volatility. When we got in, it was lower right there. And then the implied volatility started moving up quite a bit as well. And the reason I'm pointing that out is because most people think of rising volatility meaning that the stock is going down or that it's bearish. But implied volatility does not measure bullishness or bearishness at all. It measures demand for options. And in this case, the demand for options was growing as the stock was moving up. That was what was going on back then. So I bought these options going out to February, and on Tuesday, before the options expired, I just looked up the bid price if I wanted to close that trade out, which the next morning on Wednesday is what I did. So I paid, if I got this price, I paid $812.50, and I could close the transaction here for $9,300. That's an enormous gain. That is a fantastic gain, huge. And we were really happy. We were very happy about that. And you can see here, as I was looking at this price right there, we had a couple of down days, and we were in the last week of the trade, and we had a couple of down days. We didn't want to give back any of that $9,000. It's like over 1,000% gain, and we didn't want to give any of it back. And so we looked at the price, and the price wasn't this exact price on the following day, on the next day, which would have been Wednesday. But it was Wednesday before the expiration. We were up so much, the stock had a couple of down days. We're like, let's just get out and lock in those massive profits. Well, on Wednesday morning, I'm out. Right there was the open. And I don't know if you can see this, but the open price here, which is split adjusted, says $33.53, and the price at the close is $51.07. So the stock has already doubled and made us a ton of money. In the morning at the open, we decided to bail out, and by the end of the day, it nearly doubled again. That's frustrating. That is so frustrating that we got out. Here's what we could have had. If we just waited till the end of the day instead of doing it in the morning, that option price went up to $167.50, which is $16,000. We made $9,300 around there, but we left a lot of money on the table. That was the day that everybody in the office, we all remember that day, exactly what we were doing, every word that was said. It got burned into our minds because we missed out. And all we had to do was stay in the trade. So when people ask me all the time, oh, this trade's up this amount, is it time to get out? This is the first thing that runs through my head. And this is why when we're in these trades and I say, we're swinging for the fences and there's time, the stock's doing what you wanted it to do, you're making money, why would you want to get out? Well, I don't want to give back any of my profits. I didn't want to give back any of my profits either. But if I don't have some skin in the game, if I don't have some money there, I could be missing out on a lot more. And this is where I learned that lesson. And it was funny because Don, when he was talking, he came into the office and he said, okay, from now on, when you guys answer the phone and I'm calling, you answer the phone and say, how high is too high? How high can a stock go before it can't go any further? And pointing out the current market that we're in, the comment that Joan made about Snap. She noted that Snap does not have good money flow as far as professional investors that are big hedge fund guys and other ETFs aren't buying it, and it's overbought. So the Fed has their foot on the economic gas pedal like never before. Snap is right in the middle of a whole bunch of potential things that could make the stock price move either up or down. And people are talking about social media stuff like TikTok and all these other things are in the news. I don't know how these options could be this cheap right now. It kind of is a little bit mind-blowing to me. But the fact that those people are ignoring it might be what's making this option cheap enough for me to be able to buy it. And I know that the stock makes big moves around earnings announcements. When I say you need to learn to think a little bit differently, take all the information that you know about stocks or about assets, whatever you know, bring it to the table and just flip your thinking a little bit to say, if this is what I think is going to happen to the stock, how will that affect my option trade? If the stock is overbought, then there could be a potential reversal to the downside. And fortunately, we have a straddle. And if something happens that just causes the stock to tank, we would be very happy with that. Paul asked another question. In the past, when you've shown us how to evaluate a straddle trade, you've checked the MDM with data during the start of the virus, effect of the market removed. On this trade today, talking about Snap, you did not do that. Are there times when you do and times when you don't remove the data? The reason I ask is that I've been evaluating every straddle candidate by removing that data. Should I or shouldn't I do that? How much time has to pass before we don't remove that data? Again, fantastic question. Fantastic question. And it answers to the same thing. Everything that you know and you can bring to the table from your stock trading experience or other trading experience, whatever it is, bring it here. It's going to be helpful, but you got to think a little bit differently. So I knew this before we were pulling the Snap trade up, but Snap trade has less than 4 years of data. And so I just put these two graphs up here side by side so you can see. One of them is with the COVID data and one of them was without. It's pretty indistinguishable. One has slightly smaller tails than the other. And that's the difference. So I knew that it didn't matter. I've been looking at Snap for a little while ever since I made so much money on it. I've been looking at it since it came back on the list. So the answer to my question is, how long do you wait? And this is my answer. I just want you to have a reason to exclude or include data beyond the defaults. So whenever you're doing something, I just want you to have a reason to do it. Because I don't always pull data out or put data in unless there's a reason behind why I'm pulling data out or putting data in. to evaluate. And in this case, I'm looking at Snap and saying, is Snap going to behave? Was it affected by the COVID crisis any more than any other time during Snap's life? And I made money during the COVID crisis on a trade, a really good amount of money. How is the COVID crisis affecting this particular stock? And I don't know, looking at a chart, that it did much. Oh, I didn't put a chart up to date on there. I don't know that it affected this particular stock as much as it affected everything. Everything got a little bit more volatile and took a little bit of a dip, but was it a real sizable event? And is that event going to happen again? Is there a potential for another move of a similar size during the life of the options? That's what I'm thinking about when I add or subtract data. If you don't have a reason, a logical reason why you're adding or subtracting data, then just keep the defaults. That's what I do. The default is 4 years, and the reason we use 4 years is because that gives us statistically meaningful data. Okay, that's all I have for today. I hope it was helpful, and I hope it helps you to realize. So the big lesson I want you to get out of this isn't how to stay in the trade, even though that's one of them. I want you to get out of this. When you're swinging for the fences like that, I want you to be able to stay in and make sure you can get all the way around the bases and get everything that you have the potential to get. The thing I want you to also learn is that the information that you have about trading is valuable, but I just need you to flip that switch in your brain to understand how is it going to affect your option trade, because option trades are not stock trades. They really aren't. And once you flip that switch, it's hard to look at things without looking in that context. So if you can get your mind to that place where you're thinking in terms of options related data information, then you'll arrive. Okay. So I hope you guys have a wonderful evening. I'll be back here tomorrow. Send me your questions, send me email, and we'll see you then. Bye.